Give your debit card, sir. What? How is this possible? Your debit card gives a criminal direct access to your retirement money. Not access to a line of credit, not a pending charge, the actual cash in the account where your Social Security check lands every month. And the people who find this out the hard way usually had the same belief. My bank has fraud protection. I'm covered. Your bank does have fraud protection. What most people don't realize is that fraud protection doesn't stop the money from leaving first. The money leaves, then the investigation begins. And while that investigation is happening, your mortgage, your utility bill, your insurance premium, and your prescription payments don't stop. Today, I'm going to tell you why debit card fraud hits retirees harder than almost anyone else, the federal rule most people have never heard of, and the simple account setup that can prevent a stolen card number from ever reaching your retirement income, instantly, the moment it happens. Before I go one sentence further, I want to address the 3 reasons most people watching this will assume this video does not apply to them, because all 3 are wrong, and all 3 will cost you if I let them stand. The first assumption: you check your balance regularly so you would catch fraud fast. What you will catch is the aftermath. The money leaves the moment the transaction posts. A skimmer installed at a gas pump you stopped at 3 weeks ago can generate a $2,400 withdrawal at 3 in the morning on the exact day your mortgage payment is scheduled to go out. You will catch it at 9 a.m. when your phone starts ringing because the payment bounced. The second assumption: your bank has fraud protection, so you are covered. Your bank does have fraud protection. What your bank does not have is a rule that puts the money back instantly while they investigate. The investigation happens first. Your account stays drained during it. That investigation can take 10 business days under federal law, up to 45 days if the transaction crosses international lines. Your bills do not wait 10 business days. The third assumption: this is for people who shop online and you use your card in person at places you trust. According to FICO's 2025 data, more than 243,000 debit cards were compromised by skimming last year alone, up 5% from the year before. And skimming is by definition a physical attack. Gas stations, ATMs, restaurants, where a server carries your card out of your line of sight for 45 seconds to run it at the terminal. The transaction looks completely normal. You signed for it, and your card number is already cloned before you finish your meal. Later in this video, I'm going to show you the simple 2-account system that financial professionals use to make sure a skimmer can never touch the account where their income lives, and why this protects you not just from a slow drain, but from the kind of instant, middle-of-the-night withdrawal that can empty an account before you wake up. It takes one phone call to set up. I want you to keep that in the back of your mind as we go through the rest of this, because every problem I am about to describe has a straightforward fix, and the fix is the same every time. Now, here is why none of this ever comes up in a conversation with your bank. Every time you swipe a debit card, your bank earns a fee from the merchant. The more you swipe, the more they earn. That means the branch manager, who has been friendly with you for 15 years, has no financial reason to sit you down and say, "Here is the payment method in your wallet with the weakest protection and the highest risk of instantly draining your checking account." That conversation costs the bank money, so it never happens. That is not a conspiracy. That is an incentive. And here is what makes it worse. In 2026, Congress voted to roll back the rules that would have capped overdraft fees at $5. Americans paid over $12 billion in overdraft and return payment fees in 2025. The banks collecting those fees are the same banks that profit every time you swipe your debit card. Here's the difference between your debit card and your credit card that your bank will never put in writing for you. With a debit card, the money leaves your account the moment the fraud happens, instantly. If you catch it fast and report within 2 days, your maximum loss is $50. Wait longer than 60 days, and you could lose everything the criminal took. The bank is not required to return $1 beyond what the law requires. And during the investigation, which can run 10 business days or longer, your account stays exactly as drained as the criminal left it, in an instant, the moment they hit submit. With a credit card, the fraudulent charge never leaves your account in the first place. It sits as a disputed item. You owe nothing on it while the investigation runs. Every major issuer in the country will reverse it immediately when you report it. You never lose access to a single dollar. 2 cards, 1 wallet. One of them pulls money from your account instantly before anyone investigates. The other one does not. That is the entire difference, and it is the one your bank is not explaining. Here is the scenario that plays out thousands of times every month across this country. A 67-year-old retiree has her Social Security deposited on the 3rd of the month. The amount is $2,711. She uses her debit card for groceries, gas, and a few online subscriptions. On the night of the 4th, a criminal uses her card number, taken from a skimmer at a gas station she visited 2 weeks earlier, to make 4 purchases totaling $1,620 at retail stores in another state. It happens in minutes. She wakes up on the 5th, and her account balance is $451. She calls the bank immediately and reports the fraud. The bank opens an investigation. Under federal law, the bank has 10 business days to provisionally credit her account. Some banks do this right away. Many do not. They are legally permitted to wait until the investigation concludes before returning anything. Meanwhile, her automatic mortgage payment of $890 goes out on the 10th. Declined. Her utility payment of $140 goes out on the 12th. Declined. Her supplemental insurance premium of $210 goes out on the 15th. Declined. Each declined payment generates an overdraft or returned item fee. At the major banks most seniors use, that fee still runs $34 to $35 per transaction. And each creditor may charge its own returned payment fee on top of that. By the time the fraud investigation closes and her funds are restored, she's incurred over $100 in bank fees, $75 in creditor fees, a returned payment notation on her insurance file, and 12 days of calling every creditor individually to explain a situation that was not her fault and that nobody warned her was possible. The fraud was not the worst part. The infrastructure collapse around the fraud was the worst part. And every bit of it started with one card, attached directly to the account where her income lives, and one criminal, who, in a matter of seconds, emptied it. This is the part where some people watching think this still does not apply to them because they have reserves and a couple thousand set aside. If that describes you, I want you to stay with me for the next few minutes, because the strategy I'm about to describe is not just for people living close to the financial edge. It is for anyone who does not want a criminal in another state determining the timing of their financial disruption instantly with one swipe, and the setup takes one phone call. The strategy is called account separation, and it is what people inside the financial industry have quietly used for themselves for decades while handing debit cards to everyone else. Here is how it works. You maintain one account as your primary account. This is where your income lands. Your Social Security deposit, your pension check, your investment distributions, all of it flows into this account. You do not hand this account number to merchants. You do not swipe a debit card connected to this account at gas stations, grocery stores, restaurants, or anywhere a terminal could be tampered with. This account is where your money lives, and it faces the world as little as possible. Then you open a second account, a spending account, with a separate debit card and a low balance you fund periodically from your primary account. You put $300 in it at the start of the week. You use that card for routine daily purchases. If a skimmer captures that card number, the criminal gets instant access to whatever is left in the spending account. $300 or less. Not $2,711. Not your entire monthly income. Not the account your automatic payments run through. Better than a spending account debit card is replacing it with a credit card entirely. Not to carry a balance, not to pay interest. You use the credit card for every purchase. You pay it in full each month on the due date, and every transaction on that card is protected by the Fair Credit Billing Act. Zero liability, immediate reversal if fraud occurs. And your checking account, the one your mortgage and utilities and insurance run through, never touches a merchant terminal in your life. If you do not want a credit card because you do not want the temptation of a balance, the two-account debit strategy works just as well. The principle is the same. Put a wall between the account where your income lives and the account that faces the world. A criminal who skims your spending card gets $300 and a headache. A criminal who skims your primary account gets your rent, your electric bill, and your medication budget, instantly, in one transaction, in the middle of the night, while you are asleep. I want to address one more thing directly before we move on. Some of you are thinking your bank already offers a zero liability policy on your debit card and you are covered no matter what. Here is what that policy actually is. Your bank's zero liability debit card policy is a voluntary internal policy. It is not a federal law. The Fair Credit Billing Act protection on a credit card is a federal law passed by Congress. Your bank cannot change a federal law on a quarterly earnings call. Your bank can change its own internal policy anytime it chooses. Banks have restricted, narrowed, and added conditions to their voluntary zero liability policies before, and they will do it again when fraud losses climb high enough. The people who rely on a voluntary bank policy instead of a federal law are one internal memo away from a very different conversation at the branch. There are 4 specific situations where a debit card is still the right tool. I want to be exact about them because the goal here is not to throw your debit card in the trash. The goal is to use it only where it makes sense and nowhere else. ATM withdrawals at your own bank's machine. You are withdrawing your own cash, not presenting your card number to a merchant system. Use your body to shield the keypad when you enter your PIN. Before you insert your card, take 2 seconds to check whether the card slot looks loose or different from what you remember. A legitimate ATM card reader is solidly attached to the machine. If anything moves when you touch it, walk away and use a different machine or go inside. The skimmer risk at an ATM is real but manageable with 2 seconds of attention. Small local businesses that do not accept credit cards are a reasonable exception. Pay the minimum amount needed for that transaction. Use the spending account card, not your primary account card. Government payments and utility bills where the agency charges a credit card convenience fee of 2.5% to 3% make sense on a debit card. On a $200 utility bill, a 3% credit card fee costs you $6. If the same payment posts for free on a debit card, use the debit card. Use the spending account card, not the card attached to your primary income account. And any business that offers a cash or debit discount, same rule, spending account only. Here is your security checklist for every debit card you keep active. Transaction alerts set to every single transaction in real time, not a daily summary digest. One text message the moment your card is used anywhere for any amount. The second a transaction appears that you did not make, you know, not days. Call your bank today and confirm this is running on your account. If it is not, ask them to turn it on before you hang up. A daily spending limit lower than your bank's default. Most banks automatically assign debit spending limits of $500 to $1,000 per day. Call and ask them to lower your limit to $200 or $300. This does not prevent you from making larger planned purchases with a quick call to authorize them. It does mean a criminal with your card number cannot run $900 in transactions across 3 states before sunrise. Never store your debit card number in an online retail account. If that retailer's database gets breached and your card is stored there, your checking account is the breach. Enter the number manually each time, or ask your bank about virtual card numbers if they offer that option. Review your account every 3 to 4 days, not monthly. The 60-day window in the Electronic Fund Transfer Act is not generous. Discovering fraud in Week 7 is already inside the zone where your legal liability expands significantly. 3 minutes every few days. Open the app. Scan the last 10 transactions. Anything unrecognized, call immediately. And one final rule that applies every single time you stop for gas. Never swipe a debit card at a gas pump. Walk inside and pay at the register, or use a credit card at the pump. Gas station pump skimmers account for a disproportionate share of all debit card fraud reported to the FTC each year. The pumps sit unattended for hours at a time. Modern skimmer hardware has become small enough to install inside the pump housing where no visual inspection from outside will find it. A credit card at a gas pump costs you nothing extra and permanently removes the single highest risk swipe location in daily life from your checking account. Now let me walk you through exactly how the phone call to set this up actually goes, because I know for some of you the idea of calling your bank and asking for changes feels intimidating, and I want to take that uncertainty away completely. Call the main customer service number on the back of your existing debit card, or visit your branch in person if you prefer talking face-to-face. Tell them you would like to open a second checking account linked to your existing one with its own separate debit card. Most banks can do this in the same call or the same visit, often in under 15 minutes. Ask them to set up automatic transfers, weekly or bi-weekly, from your primary account into this new spending account, in whatever amount fits your normal week-to-week spending. $200, $300, whatever feels right for groceries, gas, and incidentals. Once that account is open, the next step is updating where your automatic payments are connected. Your mortgage, your utility company, your insurance provider, your Medicare supplement premium, anything that pulls money automatically, all of that should be connected to your primary account, the one that never sees a merchant terminal. Your new spending account card is the only card that goes in your wallet for daily purchases. Then, while you are already on the phone or at the branch, ask 3 more things in the same conversation. Ask them to turn on real-time transaction alerts for both accounts. Ask them to lower the daily debit spending limit on the new spending account card to $200 or $300. And ask them to confirm in writing, an email or a printed summary is fine, exactly what your liability is for unauthorized transactions on each account, so you have it on file in case you ever need to refer back to it. That is the entire setup. 1 call, 15 minutes, and from that point forward, the account where your Social Security check lands is permanently separated from every gas pump, every restaurant terminal, and every online retailer in the country. Here is the full picture. Your debit card is governed by a different and weaker federal law than your credit card. During a fraud investigation, your money can sit out of reach for up to 10 business days while your automatic payments keep going out and fees start stacking. Your bank's voluntary zero liability policy is not a federal law, and it can be changed without notice. The account separation strategy takes 1 phone call to set up and permanently removes your primary income account from the reach of any merchant terminal and from the kind of instant, overnight drain that can wipe out a balance in seconds. And there are 4 situations where a debit card still makes sense. ATM withdrawals at your own bank, businesses that do not accept credit, government payments with convenience fees, and cash discount situations. Use it in those 4. Replace it with a credit card or a low-balance spending account for everything else. Send this video to 1 person you know who is still running their Social Security deposit and their daily purchases through the same debit card. That 1 share might save them $2,711 next month and 10 days of phone calls to creditors while their bank finishes an investigation they never saw coming. That is what this channel is here to do. So I will see you in the next one.